In this video, I will review alternate exercises 4, 5, 6, and 14 in Chapter 8, Accounting for Long-Term Assets. In Exercise 8.4, this company has purchased a new machine and it cost $85,600. They're estimating the useful life to be 10 years or 274,000 units and has a salvage value of $12,100. During the second year, it produced 26,100 units of product. To determine the straight line depreciation, then, they will take the cost minus salvage, which comes to $73,500, and divide by 10. Each and every year, they will take 7,350. So year 1 all the way through year 10, the same amount will be taken, 7,350. And what this table represents is it shows you that every year they are taking the 7,350, and the book value is always computed as cost minus the depreciation taken. So after the first year, 85,600 minus 7,350, the year-end book value is 78,250. Then the next year, we're also taking another 7,350. So this number is going down each year by 7,350. And they're taking a total of 73,500, which is cost minus salvage. The ending book value is equal to the salvage value. We're using the same numbers here, but we're looking at the units of production method. The first part's the same, cost minus salvage, but now we're dividing by the useful life. They believe they can get 274,000 units. So for each unit, they will take 27 cents. It says in the second year, they produce 26,100. So for the second year, they'll multiply 27 cents times 26,100. And that means they will take 7,047 for year 2. Again, we're looking at the same information, but this time we want to look at the double declining balance method. You'll recall that the way you compute the depreciation is 1 divided by the years times 2. So 1 divided by 10 would be 10%. We're going to double that, so we're going to take 20%. And the other thing you have to remember for the double declining balance method is that you do not subtract the salvage value when you're making your computations. You look at book value, and book value is cost minus accumulated depreciation. At the beginning, we haven't taken any depreciation, so the beginning book value is equal to cost. And we'll multiply that by the 20%. The first year we'll take 17,120, and then we need to determine the year-end book value, which is cost minus the depreciation taken. So then when we do year 2, we're going to start off with 68,480. We're going to take 20% of that. That gives us 13,696 for the annual depreciation in year 2. And again, the year-end book value then will be the 68,480 minus 13,696. Now with this method, when you get down to the last year, you have to be careful because we did not subtract salvage value. And in the last year, you have to make sure you don't take more than the salvage value. You want the year-end book value to equal salvage value. So you have to force the depreciation. Instead of taking 20%, you will end up taking too much. You always have to be aware of that. So we're only going to take $22.61 in that last year because we want the book value to be $12,100. And in fact, we are not taking any depreciation in the year 10. The year that we have to force is year 9. And we have fully depreciated it after year 9, which means in year 10, we're not taking any depreciation. The total depreciation we can take is $73,500. That is the $85,600 minus the $12,100 salvage value. In this exercise, we're looking at, we've purchased a piece of equipment and we're hoping it's going to last 4 years. It has a $30,000 salvage value. We had to do some things to keep this piece of equipment. We paid $30,000 and we think that will increase the productivity. And then we paid $500 for just minor repairs, and we paid $18,000 for significant repairs, which will increase. And we paid $18,000 for significant repairs, which will increase the useful life from 4 to 7 years. To record the journal entries, anything that is increasing the productivity or extending the life is a betterment, and we want to increase the equipment account for that. The minor repairs is an ordinary repair, and we will debit the repairs expense. And the last one is an extraordinary repair, where we also will increase the equipment account. So here we're expected to increase their productivity. A betterment increases the equipment account. And here we're expected to increase the useful life. That's an extraordinary repair that also increases the equipment account. Paying for the minor repairs are regular repairs expense. This concludes the video on how to complete some of your Chapter 8 exercises, and your last exercise at Connect is a Tableau assignment on straight line depreciation.